some of the position taking, the hedge funds, etc., they came in more aggressively than we expected. The core sort of retail demand for gold has not changed in the last maybe 1 month or so.
Monday morning, folks, and welcome to a brand new episode of FinMet Mondays. Sunil, our prediction last weekend about how markets are going to play out this week turned out to be bang on, although the extent to which it has corrected seemed quite aggressive. Even I didn't see that coming. Quite explainable reasons, don't you think, for what has happened last week?
Yeah, I mean, I think as far as the market is concerned, they were also caught unawares. I think if you remember, we were at 2072 on Friday night, and we were thinking it'll go up, it'll hit a stop, and it'll come down. So we were expecting an upside of maybe 2090, and then it'll come down to what 2050. What we saw is an overshooting on both sides. So when it went to 2090, there was further buying, short covering, and it went all the way to 2125 briefly on Monday morning, and then it's come sliding all the way down. So I would say basically two things have happened. I think some of the position taking, the hedge funds, etc., they came in more aggressively than we expected. I looked at the ETF data. Nothing has changed in the ETF data. So really, the core sort of retail demand for gold has not changed in the last maybe 1 month or so. So what I think was happening is really the bigger institutional players were playing around with the price, playing around with the resistance and support levels that we talked about. In terms of the market participants, I think they were quite surprised about the upside and also now surprised about the downside.
Downside.
Largely, if you saw the move even on Friday, the jobs report came better than expected in terms of the dollar. And so therefore the dollar was stronger. Maybe you want to explain that in more technical basis, what exactly happened.
Definitely, Sunil. Let's dive right into it. It's quite mixed in terms of sentiment. You see the RSI also treading in this sort of $50 range, 50 range, which basically says that they're looking for a solid direction. They're looking for some more movement on, or some data on where prices can go. It's kind of rotated back into those levels. In terms of supports, we definitely have the major psychological support at 2000. This is probably going to be tested come Tuesday when we have the inflation reading for US. I'll come into that in a bit. We have a major support around the 1975 zone. This is derived basically if I take a Fibonacci retracement right from this low to this high right over here, you see that the 38.2%, the 38.2% mark over here falls right around the 1975 zone. So that's where I feel if prices are going to correct next week, depending on how the data comes out, 1975 support is what we expect markets to hold on to at the minimum. On the upside, I think bulls will try and target the 2050 level. This is where we've corrected from last week, but this is again an attractive proposition for bulls if they want to climb back and take prices higher. Commenting on some of the bits around the Fed rates. Now, next week, we also have the last economic FOMC meeting of December. More than the fact that Fed is going to keep rates unchanged, what people are really looking forward to hear is what are their projections for next year? How early are rate cuts going to be introduced? So let's dive a little bit into that. Firstly, there's a 97% chance that the Fed is going to leave rates unchanged. So there is solid probability on that. There is no lack of clarity in that regard. In terms of when the Fed is going to cut back rates, if you look at this particular row item here that I've highlighted, there is the ease of cutting back rates. It's about 45% in March. But this is what market participants are doubting now. They're saying that if the Fed is going to remain hawkish, even now, even in December, the earliest we're going to have the first rate hike is somewhere in May. And that's not going to be very helpful for gold prices. You're going to have to wait 5 months for the first action from the Fed to come in. So that's going to keep prices tethered to 2000 and not really able to facilitate the rally. The other bit is also the dot plot projection. Dot plot is nothing but the summary of what the Fed members are going to anticipate they are going to cut back rates on. So whatever their understanding of the market is, they're going to basically say this is what we expect the Fed funds rate to be at the end of a particular year. So if you see at the end of 2024, it is the red dot is what the median projection is. It's somewhere around 4 to 4.25, which is nothing but a 100 basis point decrease from what we are currently. This as well is what we're looking to kind of get a revised picture of, because this was updated in September and now we're going to have a revised reading come in December. So all in all, to briefly summarize, we have the inflation reading on Tuesday. We have the FOMC projection and interest rate decision on Wednesday midnight. Both of these are going to jointly decide the trajectory of gold. My hunch is that the Fed is going to remain on its hawkish path, which is why you're going to see this 2000 level slightly tested, and you're going to see a correction down to 1975. But again, this is heavily dependent on the data, so we'll have to wait and see how the market plays out. Thanks, Sunil. That completes our roundup of the coming week. Hope markets play out as expected. But yeah, till then, thank you so much and goodbye.